our last video, we have introduced merger and acquisition by discussing buyer motivation as well as takeover tactics. In this week, we will continue with the topic with further discussions on acquisition currency, valuation, as well as anti-takeover tactics. First, we will be focusing on acquisition currency in this video. Acquisition currency can be cash-based, share-based, or a mixture of cash and shares. A buyer needs to think about acquisition currency because the choice of acquisition currency can influence the buyer's balance sheet, credit rating, share price, and its future operating model. Using cash to pay for shares is a clear and straightforward way to transfer ownership, but paying with cash may not always be feasible. In cash-based acquisitions, a buyer would often need to issue bonds to finance its acquisition. Taking on additional loans will increase the amount of leverage and negatively influence its credit rating. A credit rating downgrade after a leverage acquisition may lead to higher cost of capital. If a buyer does not have a strong balance sheet, increased leverage will influence its business going forward. In tender offers, cash payment is the sole choice because an acquirer needs to make money payments to a large number of shareholders. In share-based acquisitions, a buyer issues new shares to pay for an acquisition, which means the selling shareholders of the target company will receive shares of the combined company after the acquisition. Share-based acquisition can have negative impacts on the acquiring company's share price because new shares issuance is dilutive and has negative impact on earnings per share. Also, if more than 20% of outstanding shares of a U.S. public company are to be issued in an acquisition, a shareholder vote of the acquiring company is required. Also, an acquiring company is more inclined to pay with shares when its shares are overvalued, and high PE companies use stock more frequently than low PE companies. Paying with stock seems to signal that the share price of the buyer is overvalued. This signaling effect may lead to additional downward pressure on the buyer's share price. But share-based payment is more tax efficient for the selling shareholders. In cash-based transactions, the selling shareholder needs to pay taxes on any realized capital gains. In share-based transactions, the exchange of shares does not involve cash, and the capital gains taxes are deferred until the shares received from the acquisition are sold. Additionally, the selling shareholders become shareholders of the combined company in a share-based transaction, so they can still benefit from future business opportunities of the selling company. In share-based transactions, a buyer can pay either with fixed share exchange ratio or floating share exchange ratio. The exchange ratio means the number of shares an acquiring company that will be used to exchange for one share of the target company. For example, if the buyer and seller agree with a fixed exchange ratio of 2, the acquiring company will deliver 2 acquiring company shares for every outstanding target company share. That even though the buyer and sellers agree to an acquisition, a deal may take months to close after the acquisition announcement. Share price risk is prominent before a deal is closed. the economic value of the payment will vary with the share price of the acquiring company. So, fixed exchange ratio brings uncertainty to economic value of a deal. If buyer and seller want to get away with share price risk and fix the economic value of the deal, they may choose a floating exchange ratio. If a buyer pays with floating share exchange ratio, the exchange ratio can float up or down to reflect change in acquiring firm's stock price and to maintain a fixed economic value of the deal. Okay, in this video, we have discussed cash-based acquisition and share-based acquisition. And we have compared fixed share exchange ratio and floating share exchange ratio if a buyer chooses to pay with shares. Thanks for watching. In our next video, we will move on to discuss valuation techniques.